Okay, I think yeah, we can start now. Yeah, anyone else who joins in can come in a bit later. So yeah. First thing, a slight format change. So today, to see if we can make it a bit more interactive as well. If you do have any questions during today's session, yeah, feel free to actually request to I think I'm not sure how you do it, but I think you can request to talk if you want to ask a question, and then you can ask, and we can also open up a discussion. So I'm just gonna share my screen. 1 second. I should be able to. Okay, so this is where we left off yesterday. We discussed those government venture capital, and yeah, before we move on to the debt and grant types of finance, there was one last equity form of finance that I to go over. And this is actually quite a new entrant into the entrepreneurial finance scene, but it's actually growing in kind of importance in the scene. And these are actually family offices. So family offices have traditionally been sort of the wealth management firms, so to speak, of very high net worth families who might have owned like conglomerates or big businesses, and they look after all the family sort of affairs and wealth management. Yeah, I mean, traditionally these would invest in sort of equities or in real estate, but recently, due to the returns, the potential returns, as we can see, that a startup can offer, they've actually recently started investing in startups, to diversify, and the types of startups they might actually invest in might be sort of similar to the technologies or industries to which they have been in, and they generally provide equity and have long-term financial goals as well. As you can see now, they actually now account for 1 to 5% of early stage finance, which seems quite a small amount. But if you put that into perspective of the actual amount of early stage finance that is there, it's still reaching up to, say, $1 billion. The difficult thing with this sort of finance is it's not exactly easy to approach or find a family office. So it's not quite as profile as venture capital, say, that have websites and attend regularly pitches and things like that. But it is of growing importance within Europe. The next so moving away from equity finance, which invests in the shares of the company, looks for ownership of the company. There is actually there is debt finance as well. Debt obviously has a very negative connotation to it because See debt, when it's heard of in the press, you think of big debt levels and people struggling to make payments. But what you see here is, the debt can actually be used very constructively if you have a solid plan on how you intend to build your business. So, starting from the top, debt finance is when a firm raises money by selling debt instruments to individuals or institutions. The most common, of course, for most startups would be, going to a bank and raising money off them. Obviously, in return for raising money, in return for lending money, the institution, so the bank, becomes a creditor and will receive the promise of being paid back the amount they lent, in addition to interest payments on top of that. That could be something like 3, 4, 5%. What they're really interested in is those monthly payments, and they're going to be very meticulous at making sure they're going to be a bit less flexible, say, than equity investors who have more patient, long-term objectives. In corporate finance, this refers often to bonds, but for startups, the main sort of debt finance will be, talking to your local bank in the corporate finance section. An alternative, in fact, to bank financing, but is actually also commonly done by startups, is issuing loan notes. And this could actually be another way to bring on board family founders or friends, and these effectively work as sort of IOUs. So someone can lend money to the company, and you can promise to pay it back and with interest as well. This is quite an interesting thing if you are looking to raise money of family and friends, because when you're at a very early stage of the business, someone could say offer you 50,000, and because you're at such an early stage, you'll give them 5%. But in the long run, if you really believe in your product, or you believe in the business opportunity it presents, 5% could become, quite costly to you in the end if you sell your business, say, for say 100 million or something in the future. That 5% could then end up costing you, if you didn't take on any other finance at any point, 5%. By then it will probably realistically be diluted, but still it'll be way more than paying back 50,000 with interest on top of that. It also, by receiving loan finance, you don't have to then take somebody on board as an investor and as potentially someone who is going to have a say on the way you run your company. So yeah, by raising by raising equity finance rather than debt, startups can raise, say, flexible money, and they are under less time constraints or any obligations to pay. And it might seem, quite beneficial, but you're using someone else's money, and you're very more relaxed about what to do with it. But as I mentioned, it's an expensive form of money, because you're given a portion away of your company and all the work that you've put into your company and the intellectual property that might be within your company. This means that founders are given investors' rights to put a percentage of the company growth and profits for potentially eternity. If your company lasts for 20, 30, 40 years, that's a long time. You're going to be paying this stuff back with the bank. It could be 5 years or something. So think carefully before actually giving away equity. And compared to debt, finance, the cost of accepting that money is high, is much higher. On the short term, debt finance might seem more expensive, but in fact, it provides funding at lower rates than equity finance, especially at the moment in periods of, say, low interest rates. When they have low fixed interest rates, it can actually end up being quite a cheap way. But of course, once again, you must consider pillar that you are able to pay that back. There is another advantage, and this is going to be a little difficult to explain, but yeah, debt finance is very effective for this reason called leverage or the gearing effect. And I suppose what this means is you can actually increase eventually the amount that will be returned to you as a shareholder by using this cheaper form of debt finance. I mean, so I'll use an example here. Imagine your company needs say 5 million or another 5 million if you've already started. So you could go to shareholders or venture capital companies to raise that money, and you have calculated that once you've raised the 5 million and you've invested it, you will make a 20% year-on-year return from the money you have invested by then selling your fully developed product. And yeah, so this would be 1 million per year on 5 million raised. Obviously split between that 5 million equity of shareholders, which would give them 20% return on investment. Obviously, 20% is really good, but it could actually be increased for the shareholders with an alternative capital structure, so the debt to equity ratio. So if instead of raising 5 million in equity finance, you ask 1 million in equity finance, and you manage to borrow 4 million in debt finance, you could actually generate a higher return for equity holders. Because okay, if the bank lends at say a 5% interest rate, then per year you will have to pay them back 200,000. So that's 5% of 4 million. So if your company then makes, as we said, the company will create 1 million per year of that total 5 million investment. You then can deduct that 200,000, that 5% of 4 million that you need to pay back the bank, and that leaves 800,000 in profit for the shareholders, and the shareholders only invested 1 million. So a smaller pool of shareholders sharing a much bigger return creates a return of 80%. It's a little difficult for me to explain that here without say a whiteboard and with the maths. But yeah, these slides are here, and it's worth looking at that leverage or gearing effect. But this might be something that you might want to consider, where you will consider, not right now at the startup phase, say, but maybe when you're bringing your first revenues in and you've got that proven market that you can raise finance from the bank. So it's a good way to stop, again, giving away all your equity and keeping your company within you and actually increasing the value to the shareholders, so to yourself. Of course, there is a downside to debt finance and financial leverage. A company can have too much debt, and obviously, we all know the bad parts of debt. Too many regular interest payments, commitments mean that if you do face a downturn or a decline in business, and you don't innovate quickly enough and change your model, you could face that point where you have too many fixed costs, and just a couple of years of loss or lower sales can wipe you out and force liquidation. Banks aren't, unfortunately, very empathetic with clients. They will start to look to take your assets, etc., very, very quickly. Of course, there's the other thing. It's very difficult for startups to raise funding for the banks. or if they do receive loans because they're considered high risk loans, they will put you on higher interest rates, expected terms, late penalty fees, and they might put warrants on the business, and that means that if the startup or if the business doesn't succeed, they'll be able to either take equity in the company, or they can have rights to the intellectual property of the company or any other assets in the event of a default of payment. So you've got to be at a point where you're quite comfortable in your business model when you're taking on debt finance. This is because businesses do look for banks do look for businesses with a track record and a proven business model to lower risks. They'll look for cash flows, revenues, profitability, and assets to act as collateral or a guarantee against the loan. What they want to see is the ability that you can actually pay back the principal, so the amount you borrowed and the interest on top. They often use this metric called the debt service coverage ratio. That is, the amount your earnings before tax covers the total repayments, so the principal and interest. And I think the lowest they'll ever look is 1.5 times. So you must be at a point where you're profitable enough to cover those payments. If you don't have any assets in the bank, they will then ask for a personal guarantee. So they might ask you to put some personal assets as collateral. But obviously, this is very risky. Really think about what position you are in. If you ever want to put up your personal, you've got to be very secure in your business. But also, if you've got a family or anything like that, this is something you really shouldn't consider, especially with a startup, putting anything personal as collateral to get a bank loan. It's very risky. So if you do decide to go for debt finance, look for favorable terms for startups. There are actually a number of schemes out there that offer loans for startups and more favorable terms for them. They might be government subsidized financing solutions in state-owned banks. For example, there is one in Europe that's sort of subsidized by the European Investment Fund, and that's called the InnoFin. That actually offers quite considerable loans for very high potential startup companies. I've seen a number of biotech companies receive loans from them to commercialize their innovation. But it's worth speaking to your bank about the sort of instruments that are offered for startups. But for example, things to look for are particularly low interest rates that are offered to new businesses. Maybe grace periods, so that's where for the first year you don't actually have to pay anything back, and that gives you a bit of leeway to reach commercialization. Or bank guarantees as well, or guarantees from the state where if you fail to pay, the bank will cover you or the state will cover you, and these will reduce costs for you with debt finance. But as this isn't something that probably many of you will consider, just wanted to put it out there because as I said, it is interesting and it can potentially offer you a nice way to increase your actual profit margins for yourself as a shareholder. Okay, so next on the list is something that I think might be much more interesting and relevant for a lot is our grants. So what are grants? A grant is an award, usually financial, given by one entity to another. Typically, they're given by companies, foundations, or most common in all governments, so national governments or the European Commission. And are given specifically to other companies to reach a goal or to incentivize performance and to undertake a specific activity of work. So that, there are many forms of grants out there, but sort of research grants are the most common and the ones that a lot of you will be familiar with. In Europe, the main grant bodies are the European Commission and national governments, and a lot of that money managed by national governments. It does actually also come from the European Commission. It's part of their sort of regional development funds that they give the local governments a certain pot of money to manage and offer enterprises or individuals within that area. I mean, an important thing really to remember about grants is that the money comes from the government, but where does the government get the money from? And that's actually an important thing to remember with these. This is taxpayer money, grants. So as it's taxpayer money, it can't be thrown around, mustn't be squandered. It must be spent wisely, and that's why there's very strong evaluation and due diligence processes when governments look to give away grants, because they cannot be seen as spending them wastefully. And when you receive a grant, also don't waste it, because if the government find out that their grants are being wasted, they'll be taken away. And this is a very, very important source of funding to enterprises, because it doesn't actually have to be paid back, especially providing if you reach the goal or the objective of the work. There are other, apart from like research grants, there are other grants for achieving financial and specific social impacts. And then, when you're looking for grants, there are sort of two types of grants available as well. There's top-down and bottom-up grants. So top-down is when they have a specific goal or objective they're looking for. So it might be, we are looking for a solution that can help solve problems of air pollution within certain environments. And so you'll be presenting your solution as a response to that grant, and you'll be showing how you can impact that problem that they're trying to solve. That means that you've got to scour and find out grants that are relevant to you. The disadvantage of it, sometimes you might have to kind of almost reposition your solution and maybe slightly veer away from your original or your planned business to make sure you fit within their scope. On the other hand, there are also bottom-up grants. Bottom-up grants are meritocratic, so they're just looking to fund a number of companies that are offering exciting solutions, and it's based really within, say, an industry, and it's more based on meritocracy, more like a venture capitalist which company has got the best solution, the best team, is in the right market, and of course will offer the highest growth potential or job potential. Because with grants, what they are trying to do is have a eventual benefit to the government that is offering the grants, and that will be a lot of the time they're looking to increase jobs or increase GDP eventually, because as we said, innovation is a big driver of economy, and the government wants to drive that, so they do want to give these grants away as long as it has a positive impact then on society and the country. There are also reimbursement grants and lump sum grants. So funding based on reimbursement grants is where they give funding based on you showing what you've spent and how you've incurred costs over a certain period. The problem with reimbursement grants, of course, is it means that you will need some sort of cash flow to first be able to undertake the activity before you receive a refund. But they also means that there's an extensive amount of financial reporting involved, and which makes them kind of prone to error. They do sort of audits at the end of the work, make sure you've achieved your technical goals, and then they look at exactly where you've spent your money to make sure that they can reimburse it. Otherwise, there are lump sum fundings, which is considered much more simplified, and they sort of remove a lot of the obligations of that cost reporting. And what they do instead is they give you a certain amount of money at the beginning of the project to undertake your work, which is fantastic if you don't have cash flows available to undertake the work. And then, of course, they will obviously check that you spend it correctly, but at certain technical milestones or commercial milestones, they will then deliver further lump sums until you receive the full amount of grant. And yeah, as we said, providing you pass all your technical and economic assessments, you don't have to pay the grant back at the end. So it's a very good way of moving along your product roadmap towards commercialization without having to give away equity in the company or take on debt payments and have that risk. Okay, yeah. So okay, great. It's it's effectively a kind of free money in a way, but as we remember, it's taxpayer money, so it must be valued with a long-term plan and what impact you're going to make on society or the country that gave it. But there are some disadvantages of grants, which sounds difficult when it is so beneficial. One thing is, they can be a little restrictive in the sort of activities they can fund. So when you receive money from venture capitalists or even banks as well, it can be like working capital. Well, sometimes these grants can have specific places you can't fund it. For example, you can't fund it on certain members of staff in a certain role or certain types of subcontractors or companies. For example, research grants you wouldn't be able to spend on say marketing or otherwise in the opposite of commercialization grant. If there are some bits of research you've identified that could potentially improve your solution, you can't actually fund research with it. Some grants don't allow you to invest, say, in infrastructure. And in addition to that, they can also sometimes be a little inflexible to the needs of a startup, say. So they'll have, you'll present your plan, you'll present the amount of money you need, you'll present the timings you need, and they'll really expect you to stick to that for you to receive the rest of the payments. But as you know, a startup can change quite a lot within a period of time, and therefore it might not fully really support the needs of a startup. You might be stuck on a roadmap that is no longer useful to you, and changing that will then be quite bureaucratic and full of red tape. Some of the startups also have completely random requirements. So they might be like, okay, we need an SME, or we're looking for a university spin-off to tie in with a university in Russia, and we then also want to include some industry, and then so you have to make this this project that follows their requirements. That in fact doesn't really quite isn't exactly designed for what you really need to do. In addition, there's lots of paperwork. The applications can be very expensive and take 2 to 3 months of work to say repair, and then when you get the grant, then you've got to constantly report and report your financial and technical activities, and some reimbursement grants constantly provide proofs of payment and invoices. So yeah, it can be more work than venture capital. And a lot of grants also they require consortiums to put together, which means then you're kind of stuck with a partner company, and if that partner company behaves differently than it did at the beginning of the grant, or doesn't sort of keep to its agreements, you're stuck with them. You can't quickly change service provider or subcontractor, which is a benefit of having sort of venture capital money. You can quickly change and choose what you want to do. And then in these consortiums as well, there might be the restriction that you need to share results of the project. Well, if you take venture capital, you keep all results from the spending of that funding within your company. As we said, if it's a reimbursement grant, it might require cash up front, and they are also very, very competitive. So I mean, the government wants to issue these grants, but as we said, they also do a lot of due diligence, and sometimes it seems like they don't want to issue it. But in addition, they are very competitive, because it's you don't have to, as I said, take on debts and pay it back with equity. You don't have to give away any equity. So very, very attractive things. They do become very, very competitive. Some of the European funds have sort of a 1%, 2%, 3% very low success rate, very similar to the success rates we spoke about of talking to say venture capitalists. There's many grants out there. You'll find them on portals on the internet, and many small grants as well come out for like 5,000-10,000 innovation voucher here, 25,000 with some activities and some workshops. I mean, preparing for these grants can be very distracting from your product development activities, or from building your business, and these applications can be very time consuming as well. So I mean, my personal advice is look for grants with higher amounts of funding. I mean, you've got to think, what is 20,000 really potentially going to do? By the time you receive it and you get the drawdown, you probably need to start looking for your next amount of funding as well. So it's not going to last you too much, and if you spend all that effort in preparing the grant application, it might actually be more than the value that the grant gets you. So my advice is, look for grants with a higher amount of funding, and that are maybe a bit more flexible to your needs as well. I mean, one of the ones that I work with and will present as well, is it's probably the most interesting grant at the moment. By far, I think in Europe at the moment, is this one called the HiPEAC Accelerator. And about this grant, the HiPEAC Accelerator. This is something worth looking up if you're already sort of created your prototype or product, or your proof of concept, and you need quite a considerable amount of funding to reach commercialization. It's an instrument that provides funding to support innovative companies. It offers a grant of up to 2.5 million, that represents 75% of the total project costs, and that's for development work. So product development, maybe user testing, maybe some sort of usability work, or if you're a hardware, some manufacturability work. So making a product almost ready for commercialization, a more commercially viable product. And it now also offers equity investment up to 15 million. This is actually the first time the European Commission is putting equity into companies, and that equity is to help the company scale up and do sales. Yeah, it's meant to be for de-risking very high risk innovations. So innovations that might normally take a lot of time and a lot of money to get to the market, because it might have a lot of technical hurdles or commercial hurdles as well. It might take a long time to prove to people that it's worth its value, but they're looking for very, very disruptive innovations out there. Yeah, okay, the funding's bottom up, so we all know what that is now. And the applications are meritocratically evaluated. So looking for social and economic impact, market creation, high risk, high potential, nature of the business plan. Yeah, it's for companies that have reached TRL 6, so that's technology and readiness level scale 6. That means you've sort of got a proof of concept or prototype, and maybe it's a very ugly form of your technology, and you need to polish it and create it more robust before bringing it to market. It's for, but you've also identified that market opportunity. It's SMEs, so you must fit within those requirements, less than 250 people or less than 50 million revenues, and 43 million on the balance sheet. So if you're a startup, unless you're a startup owned by a very big company, you're within that position. And it's for EU companies only. Hang on a minute, I get the question. Ida asks, what does the other 30% account for? And I think this, you mean, yeah. So what it means is 70% of total project costs. So that means if you have a budget of 3.5 million, they'll give you 2.5 million. What they want to see is that you have, you're able to find another source to be able to fund that other 30%. So the total project is 100%, and you need to find financing for 30%. That 30% could actually come from this 15 million if you ask for equity finance, or it could come from VC, cash flows that you have, other investment you've received. It could also be if you aren't going to pay yourself a salary, or a number of founders aren't going to pay themselves a salary, they can equate their time to a value of money, and that can be a way for it. Or if someone offers like an asset or a benefit in kind to the project, also that can be used as part of the 30%. But what it means is they want to see some level of co-funding. Of course, you don't need 30% straight away. The project is 2 years long. So sort of in 2 years, you need to be able to put up 30%. In the first year, probably only 30% of say about 50% of the project. So you need to put towards 50% in the first year. And then if you do receive a grant of 2.5 million, it will make it much easier to start raising other sources of financing, because you've got the backing from the European Commission. So yeah, that's one very big benefit of grants. It's like a stamp of approval, and then you can go visit investors and show them that you've got this approval, you've got this finance, you've de-risked, and you can leverage other sources of finance. So I mean, yeah, this is just this will be in the slide deck. So it's about how to apply it. So the two-step process. First step is you apply with and you prepare a proposal or an application that includes like a 30-page sort of business plan, annexes, team description, ethics requirements. There's also an annex for your financials and company history, and then a pitch deck as well. So it's it's quite a substantial application. Yeah, we always say it takes 2 to 3 months to prepare the application in itself. And then if you get through the first stage, you then get invited to, you were invited to Brussels, they're now done online, but you get to pitch to a panel of 5 to 7 sort of investors or industry experts. And then they'll do a Q&A, so it's similar to meeting VCs, and that's how they decide on who then receives the financing. So it's a much more commercially focused grant, say, compared to a research grant. So if you've discovered, if you've started developing your technology, it's definitely worth considering in Europe. The only downside is it is very competitive, but from Horizon Europe, it should have a budget of 10 billion between 2021 and 2027. It's got quite a significant budget. Okay, finally, some alternative to ways of raising finance. So there are accelerators and incubators all around Europe. Every month it seems like a new accelerator or incubator is opening. These might be run by corporates, financial firms, or governments. They often run programs that are maybe 6 months to a year that they take in cohorts. And you have to apply as well for them to get accepted. These accelerators may have focuses, so health tech, IT, food tech, and when they take in the startups, what they offer is mentorship, advice, network, possibly even a physical space, and sometimes finances. So it's a sort of, that's why they call them incubators or accelerators. So it's quite a safe environment to grow your startup with other startups and learning off people who have done it before. Again, often they invest in the form of equity. The most famous of these is Y Combinator and Techstars, of course. Y Combinator, as we know, went on to produce things like Uber and Airbnb. So these things can actually produce very successful companies from them. Next up, we have crowdfunding. So this is quite sort of a new form of financing. Crowdfunding is like an umbrella term for groups of people who pool in money to support a particular goal. Crowdfunding is where a company presents its business plan to individuals to raise money. Often they use these online platforms. There's now quite a lot of them: Kickstarter, Indiegogo, GoFundMe, Crowdfunder is the most famous ones. This has become very popular with, say, more what's considered professionally like retail investors. So consumers, you're not targeting, say, VCs, but it's become very popular with, any sort of internet user is very interested in supporting a goal. It allows, because it as well as accessibility to investments. So the investment is widely available on the web. Often they take much smaller amounts of money as well. So you could put 1,000, 2,000, even much less into a crowdfunded project, and it will create a total amount that's being raised, made up by lots of smaller investors. There are there are 4 main types of crowdfunding. So equity-based is where companies say we're selling 10% of our company, we want to raise 1 million. And people put in money to reach that goal, and then they share that 10% of equity. The motivation here obviously is the financial report, and is the financial reward. And the average size of these are around 250,000 at the moment. Reward-based is more where you offer the delivery of a product in the future. So this is kind of like upfront paying for a product. You say, we are going to deliver this product, and if you fund us now, will then deliver you the product in the future. Backers here may be, very particularly interested in the product, or there are other things that ways that companies do this, and that's kind of ego boosting, where they say, if you give us money, we'll give you a name plaque, or we'll invite you to this private events and things like that. But obviously it's much less interesting than equity crowdfunding. So these only raise about 30 to 40,000. Donation based, so that's more for non-for-profit and charitable organizations. And then lending based crowdfunding is where you open a debt possibility to consumers, say with fixed interest rates. This also is commonly known now as peer-to-peer lending. And again, these are mainly people looking for financial opportunity. There are some disadvantages. It's very popular in crowdfunding, but there are some disadvantages of crowdfunding as well. One thing is investing with VCs, professional investors who maybe have run a business before, that they've gone through product cycles before, they've known how to bring a product to market. The disadvantage of crowdfunding is you're suddenly now dealing with a load of retail investors or the crowd, and they could be much more unprofessional or impatient, so to speak. So if you don't deliver your product or in time, which most likely you're going to have an optimistic deadline for delivering your product, and you're not going to be able to get it. If you don't deliver it on time, suddenly you start receiving all these reviews, or maybe your first product might have some bugs in it, and things like that. And you rather than being kind like a VC and giving you some advice, you might start getting trolled almost by the people who put money. They'll be much less empathetic with you than investors. Secondly, and this is a personal opinion, I think if you've got a consumer-facing product, I think crowdfunding is interesting. So here's one company I worked with. So they created an air purifier. It's a beautiful design. It's very functional, uses houseplants, offers many good benefits to the body. And this, consumers can understand. They go, I understand, pollution, how bad it is, and I want to live in a healthy environment. It looks cool, it's smart, it connects to my phone. It's all of those things that consumers will like. If you try selling an enterprise software as a service for a niche market, you're not really going to, I don't think, have too much success really, because it's difficult to describe. They might not understand the values so much, and they won't see the investment opportunity there, especially if it's for a niche market. So it's more for consumer facing. So here I just wanted to show. So look, as you can see, these guys have 3,821 backers. It was a huge amount of backers, one of the biggest. But every day they're having to spend time replying to these backers, saying I haven't received the product. And they're having to explain to the investor. They're constantly asking for updates. But with a VC, they might be like, okay, let's update once a month. Well, these guys, there's no meeting once a month where they're going to update. These guys are constantly asking for updates or knowing what's going on, or showing impatience. And it could give the eventual bad perception of the company and the product. You could actually be doing very good. You're just going through a small hiccup, or which is normal in a startup, and you're receiving all this bad press. There are cases, of course, where it goes very bad. So this was one of the most crowdfunded ever campaigns. It reached 13 million, 62,000 from 62,000 backers. And as you can see, it's another consumer-focused product. It was a cooler for your beer, say, that's also like a music box and does some other stuff. So yeah, it was very, and he did really nice marketing, cool videos. That's how he managed to get so many people wanting to buy one. But I don't know what happened, but for some reason with 13 million, he couldn't deliver the product. And now if you go on this, I apologize for the language on this page, but if you now look at it, people try and find where he lives. People are threatening him. People are swearing him, saying they want to swearing against him, saying they want to take legal action, calling it a scam. So you've got to be prepared for this. With a professional investor, you won't receive this sort of response. So just to finish sources of financing, I wanted to introduce another interesting approach to raising finance, and that's not raising finance, not pursuing equity or debt or grants, but bootstrapping. So bootstrapping is building the company from the ground up with nothing but your own resources. So your own resources don't necessarily need to be just cash. It's your time. It's anything else that you put into the business, and maybe some equipment as well. You might allow somebody to work from your house, and you work well. With luck, you build a business from your first sales and eventual reinvested profits. The risk here with bootstrapping is, of course, the cost is completely on you, and what you've got to consider here is the opportunity cost as well. It might take a long time. You might be out of work for a long time, and if you left your salary of say 5K a month in a year, that means you've invested 60K and you probably haven't received any salary as well. So there's this opportunity. There's also the opportunity cost. But if you took in further investment, they might have taken 10-20% of your company, but you could have reached a higher value, or you could have reached sales quicker. But it's a good it's a good way to remaining in 100% control of the company that in the long term could become very obviously beneficial to. So there are a number of ways to bootstrapping. The easiest. Okay, so the first way is by selling your product. Of course, you might say, well, my product's not ready yet. How am I meant to sell it? Yeah, but one way is receiving upfront payments, delivering it with the investing in it with the upfront payments, and then delivering it. But another way, of course, is also buying on credit. So if you need to buy from suppliers, you receive the goods from the suppliers and say, I'll pay back later. Of course, this is you need to be good at negotiations to do this. But if the supplier really believes in your product and thinks in the long term that they're going to have a good business opportunity with you, because they're going to, you're going to constantly be buying from them, they might be willing to offer delayed payments, or at least a portion paid up front and then a portion paid later. You can also ask for discounts or benefits of kind, so asking friends or suppliers to allow you to use their resources for free. So I mean, this is being a real and true entrepreneur. So trying to get everything as cheap as possible, trying to delay getting paid, delay paying people for as long as possible, and trying to receive money as soon as possible. Another advantage, apart from you could then remain 100% in control. You own 100%. You also remain in control of the company. so you can build the company in the way you want without pressure from outsiders. But yeah, of course, this is going to be a very difficult way of starting your company or building up your product if you require a heavy amount of capital to build and test your product. So, for example, medical startups, I think it'll be very difficult for you to bootstrap a medical startup if you're developing a device or a biomarker or something. Or if you really want to quickly scale up your company, it's not going to be a quick way to build your company. But it's a different industry. But there's I wanted to tell you a story of this man here. So this man here is Hamdi Ulukaya of Chobani, which is a Greek yogurt manufacturer. It does sort of thick Greek-style yogurt with high protein content, and it now has revenues of about 1.5 billion. This guy's net worth is, I think, somewhere is 1 or 2 billion, and until very recently, he still had 100% of the company. He only doesn't have 100% of the company because he decided to give, very nice of him, he gave 10% of the company shares to his employees, which made some of the early employees now millionaires. But he built this completely by himself with bank financing, but with no equity financing or no other source of financing. So he as he started out, so he was born in Turkey himself from like a dairy farming family and moved to the US. And he has a small feta cheese factory. One day where he was eating the American yogurt that he didn't like much, it was too sweet for him. He decided to offer Greek yogurt to the American market, which actually, at that point it was only 1% of the market. Of course, what he needed first was a factory, and he saw a yogurt factory for sale, and he managed to negotiate down the price. And to begin with, he got a bank loan. He put up some personal collateral, and he got a loan from the bank to purchase a factory for less than $1 million. It had some additional cash to keep going, and the bank provided him 90% of the financing, and he had to put down 10% on a reasonable 10-year term. He then got his first employees on board, a yogurt master, and some other people were the ex-employees of who previously owned the factory, and he got them renovating the factory. He then spent the remainder of his bank loan before that on renovating the factory and on these employees. And what he did to begin with was, instead of making his new product while he was developing his recipe with his master yogurt manufacturer, he just started selling generic yogurt on a contract manufacturing basis. Those profits were then reinvested in his recipe and reinvested in his packaging. Over time, over 2 years, he managed to develop his recipe, develop his packaging, and develop his market niche. All of that with just this small loan that he was paying off by doing this contract manufacturing. So if you're maybe in a different thing, you can considering selling your service in the meantime while you're funding your product development. And then with profits of that, he was able to reinvest them into this yogurt as well. Eventually, after 2 years, he managed to put it onto the market, and it became very popular immediately. Before you know it, he wasn't worried about generating demand again. He was worried about actually being able to fulfill demand again. So at this point, he was showing revenues and showing that there was good market for the product within his niche area, and he was able to get more financing from the bank to build a much bigger factory to fulfill the demand. And yeah, over time, he's simply grown his business that way, focusing on selling the product and then reinvesting profits and using bank financing as well to grow the company when there was a growth in demand. And you know what's happened actually is now that amazingly from 1% of US yogurt sales, well, Greek yogurt accounts for 1% of yogurt sales. It now accounts for over 50% of yogurt sales. And as we said, yeah, the Hamdi Olukaya has made himself into a billionaire. The company's bringing in over 1.5 billion in revenues. He's selling 200,000 yogurts a week, and he's done this without any external sources of financing. So yeah, I've considered looking up his story more. I don't think I've told it as well. He tells it himself, but it is really the case of the true entrepreneur who was very good at negotiating deals, so negotiating the price he paid for equipment, his bank loans. He was very good at negotiating that, you know, not paying suppliers for a while. He always paid his staff straight away, but he didn't, you know, he'd always delay payments to his suppliers, and he'd receive payments up front. And he was able to build a business that way, which is yeah, very, very impressive. But personally, I think yeah, if you are considering that method, it takes a lot of guts and a lot of grit, because it probably will be a very yeah, very long and hard journey. So on this slide here, you can have a look at it. I've summarized all the types of financing that there are. Whether it takes debt or equity, what the goal of the investment is looking for. As you can see, not all investors are just looking for financial goals. They might have other goals attached to them, such as strategical ones or societal or political goals. Then active or passive means what kind of role they take in your company. Passive investor, of course, just gives you the money and expects to be paid back at some point. Active investor will come on as an advisor and will offer a number of non-financial support roles. And then the investment target is what kind of company are they targeting? Is it earlier stage or is it later stage, or is it also, are they looking for specific niches as well? So that's how that summarizes the types of funding there are. So a few things to consider when you do choose your, okay, yeah, well, there are a number of, I mean, this is a non-exhaustive list. There are a number of other sources of finance for them, but I thought they were these are the principal ones and the main ones. You know, there are like other sorts of like mezzanine or mini bonds, or there is like distributed leisure technology solutions out there as well now that offer sort of, instead of equity, but sort of utility tokens or in your company. But yeah, these are the principal ones at the moment. So a few considerations when raising finance. Okay, so raising funds is a time-consuming activity. It is going to distract you from developing your product or developing your company. And, you know, putting a business plan together, a very compelling business plan, will take a while, and then chasing the sources of finance as well, and even doing research on the right, say, grant, for example, and exactly what they're looking for will take a long time. It's also a very difficult activity. As we said, it's the second most, after finding a product that people like, it's the second most difficult activity you will come across with your startup, and only a small percentage of businesses eventually end up getting financing from someone who isn't the founder. Yeah, before yeah, you choose the right sources, you know, you need to consider well all your options and really consider where you are on your roadmap, or as well what your plan is for the future, as well, and what availability you have to offer, say, collateral. So consider your current financial status, your position, and where you're looking to go in the future. Do you want someone to potentially sit on your board? Do you want to keep complete control of your company? Yeah, there's a lot of things. So choose carefully your source of financing. Don't just go for everything and then end up in a position where the company's not going in the way you want it to be. You've given away a lot of control, or for example, you've got lots of payments to make. So yeah, choose wisely. An interesting thing to do when looking at your sources of finance as well is to look at comparable companies. So look at a company, think of a company similar to yours, and think about the entrepreneurial journey that they have done, and look at the sources of finance that they raised in the past. Because if they're a successful company, then they might have taken a successful route. And therefore it's worth looking at exactly what route they took and what sources they took in and when they took it in as well. It will give you a good idea of maybe a route that you should be taking. As we said, different sources of financing are available at different stages of the life cycle. At the as we said at the beginning, probably debt's not the best thing to take on. Family and friends and angel investors is very good at the beginning, or selling your product with upfront payments. Then don't go pursuing venture capital at the very beginning, because you won't be able to convince them. They often look for at least a bit of traction, and then as you get later on, then your funding journey will. There are then other sources like eventually you might get private equity acquisitions, or stock market funding. We've not addressed those at all today, and it's completely irrelevant for the startup stage. But there are there's a life cycle. Consider where you are in that life cycle, what your revenue are, how developed your product is, in choosing the right source for you. Also consider that you can use several financing sources simultaneously. It doesn't have to be such a step where you go, okay, I get family and friends, then I'm going to do angels, then often these other sources of finance like to invest with, they like to co-invest with other sources as well. So if you receive a grant, consider also then trying to leverage that grant to then maybe potentially get venture capital as well. So these sources can be regarded as complements rather than substitutes to one another. Okay, so I don't know if anyone has any other questions about sources of finance. What we're going to look at now is planning, which is okay. So once you're ready to approach your source of finance, you must plan. You must present. You must plan. Okay, how much you need, and then you must also present your business plan as well. So here we'll look up at planning. I don't know how many of you attended Ray's lecture yesterday, and he said that sell. You need to focus on approaching customers, and this is true. But nevertheless, raising money will be for sure required at some point of your entrepreneurial journey, and it must be part of your plan. You will unfortunately have to approach these sources of finance, so you must therefore have a financial plan. So yeah, before choosing your source of finance, it's important to make an assessment of the actual amount of financing you need. Financial planning allows company owners to estimate the quantity of funding they need and the exact timing of the money they need to start their venture, to keep it running. So you need to start, thinking ahead. And so you might think at the beginning, well, asking me how much you need sounds almost like how big's a piece of string. But the more you do research into this planning, the more you'll be able to, and what we're going to look at, define milestones and decide exactly how much you need to achieve those milestones. So we have this, the need to make assumptions to formulate a plan to navigate the constraints to reach a milestone. What that effectively means is planning is kind of like what we do every day. You have, say, a certain amount of money and a certain amount of time, and you want to reach a certain end of goal. So actually, in doing financial planning, it's actually using a basic tool that we do every day. We make plans for ourselves all the time with on where we want to go, and we always have the constraints of time and money that stop maybe our plans being so ambitious. And it's quite strange how many business plans aren't presented with such or financial plans with such clear objectives, and it always seems very hard for a company to do this, especially at the startup stage. But using these general planning skills and presenting them very simplistically is very important in raising finance, and it's what investors want to see. And so, I mean, think about your product development plan, where you are right now and where you are to the launch. This is diagram at the bottom. It's not the be all and end all. It's just an image of classic activities that you might do along your product development process. You might do other activities, of course, depending on your sector and where you are. But you need to consider, where you are, say, on your roadmap, and what you need to achieve your ultimate end goal, which is commercialization. As we said before, the actual earlier stage you are in the process, the actual less resources you will initially require. So, idea generation, screening, concept development will take less amounts of resources. But as you go further and further along to reaching the market, despite the fact that your risks might be perceived as less big, the amount of money you'll actually need to reach the market will get bigger and bigger and bigger as you need to take on maybe more staff, and you need to take much more expensive activities such as larger scale manufacturing or larger scale testing. One important concept is you may need to make a task list that needs to be completed. First thing, you need to list your milestones. Milestones are sort of objective events that add value to the company. So, for example, new data, a prototype, beta customer, regulatory approval. These are sort of like big objectives within your plan to reach the market. That sort of when you reach them, you can then sort of move on to the next milestone. And then for each milestone, you should make a list of tasks that need to be completed before you can reach that milestone, and start thinking about how much time and how much money you will achieve that milestone. And of course, that's it seems quite difficult and hypothetical at the beginning. But the more you break it down, each milestone and to the individual tasks to achieve that milestone, the more you'll have the easier you'll find at allocating resources to that. So what I'm trying to say here that's quite difficult is don't think, okay, to reach the market, we need 20 million. That will come across as complete guesswork, and you will get a lot of questions from an investor, not very constructive questions, more asking, well, how did you get this figure? Well, I think it might take that much. You really need to break down exactly what needs to be done, and the best way to do that is decide on your milestones and decide exactly, and then split up those milestones into tasks, and start to think exactly what you'll need, and what you'll need could be personnel, equipment, materials, subcontractors, service providers, to help you achieve those tasks. Two points I wanted to say here. But one point really is that entrepreneurs are famous for not asking for enough money, and also you might think, especially in the grant applications as well, you might think that putting a small amount of money might be perceived as good value for money, good value for taxpayer money, and it will increase your chance of receiving the funds. Because I think, okay, we only need to put a small amount of money in this, and we might get a big return. If your task is going to cost 2 million, it's going to cost 2 million. Don't try and be cheap, because it's actually going to be perceived then is high risk. Because they'll be like, well, they haven't allocated enough money to the project, and I understand that this is a big product development process. It's got some big technical hurdles to overcome. They're not going to be able to do it for 1.5 million. So no, we're not going to give them the money. So be realistic about how much you need, because the entrepreneurial journey it is expensive, and don't underestimate overhead costs as well. Don't think that you'll be able to make it swimmingly without achieving without having incurred any unforeseen costs, but also just the cost of running your business as well. Can the administrative costs can be quite expensive as well. Your accountant, all these sort of costs that you don't think about when all you're thinking about is how to develop your product. What equipment do I need? What contractors do I need? Think about all those extra additional costs that you might have along the way, and fit enough budget in there, because you don't want to appear at a point when you haven't reached your milestone yet, and you're running out of cash because you didn't ask for enough money to achieve that milestone. So next important point as well about milestones is you should really only ask for money. Okay, unless you're completely out of cash, but only ask for money once you have reached your next milestone. And the reason, and as we said, milestone might be working prototype, beta customer, regulatory approval, or something like that. The reason for this is when you reach a milestone, you actually have a story to tell. You can say that you've actually achieved something. And most importantly to an investor, when you reach a milestone, generally speaking, you have increased the value of the company and you have reduced the risks. So they will be more willing to put more money into the company because it's seen as less risky and a more valuable company. And you've been seen to achieve something. So you should really assign these milestones, and they are going to become your fundraising points as well. So yeah, define milestones, exact cost you need for them, and try and follow that plan. Of course, plan might change as well, but you should always be updating your plan as well. And then, yeah, as we said, set short-term milestones. Your milestones shouldn't just be commercialization, 20 million. Set those in-between points that you're going to hit on your journey. We'll also, make for you as well, make the journey seem more achievable as well, rather than just one long journey ahead with a lot of unforeseen activities on the way there. If you're at a very early stage as well, it will also just be a complete waste of time. unless you've got a serious track record behind it, you're asking for a very large amount of money at the beginning. You need to set your first small milestone and get the money that you need to get to achieve that. Like say $500,000 or something like that, to develop your prototype. Say might be the situation you're in. Focus on that and explain what you need to get that. It will start help you and start building up your track record that you will then be able to impress later investors with, especially if you have a prototype that is working. Then when you do ask for funds, make sure you ask for 12 months additional money, in a sense, after hitting your milestone. And that's because the fundraising is a time-consuming activity. So 12 months of what could be your salary, say, you need to include there, because fundraising can take a long time. You might go through a few additional failures, and you want to make sure that you can fund yourself fundraising. Otherwise, you don't want to just hit the milestone, really be out of cash, and in a point where you might have to start doing a second job to fundraise yourself, to be able to fundraise. That will then start to show, especially in your commitment, but also it'll distract you. You want to be 100% focused on your goals. So you want to be able to have the cash available to keep looking for funding. And also, you don't want to be constantly fundraising. You want to raise such a small amount that you have to keep constantly fundraising, and you never have that time to focus on just developing your business and developing your product as well. So yeah, it's important for you to calculate your burn rate. So when you're developing your milestone plan, you must calculate an amount of money you spend per month. Of course, this will change on what sort of activities you need to know how much you're going to be spending over a period of time, so you can ask the right amount of finance. And yeah, one important thing really is incorporate your personal needs into the plan. I mean, especially if it's a start, your business and your personal life, they are going to mix. They're very much interconnected. It's all you're going to be doing at one point, and it will, especially if it's your primary income, and yeah, it may take 2 to 10 years of your life, and will go across many sort of important periods of your life as well. And you don't want your business to constrain you. You don't want to run out of gas. You don't want to be dissatisfied with what you do. You want to feel comfortable as well. To make sure you incorporate your personal needs in the plan. So put your own salary. Don't try and be to impress the investors and say, okay, I'm going to work for free, or I'm going to work on a super low salary for a while. Make sure that this activity also does support satisfy your personal plan as well. I mean, for example, if you do want to have children within a few years, consider that within your plan as well, to make sure that you don't dissatisfy your personal life, because you need to be 100% committed and serious about the venture that you're building in. Okay, so preparing your business plan. So all apart from your own finance or your friend, all sources of finance will expect to see a business plan with a financial plan. And yeah, this may come as a written document, as like a big traditional sort of 30-page document, or especially at the early stages of finance, and they might just expect to see a pitch deck, or often they expect to see both. The business plan has more of a purpose. Well, the pitch deck is often the first one that gets looked at, or that you use at your pitching events, and then when people want further information, they'll want to see your business plan and your financial plan, your Excel spreadsheet as well. As you may have experienced, startups, receive a lot of skepticism on their product, their service, their business plan from sources of finance. And so a plan is very useful for increasing the credibility of your business. But by planning and thinking ahead, it also helps you reduce the risks of unexpected or adverse outcomes. Okay, and it is true, your business plan will change, and you should regularly update it for sure, because in reality, the business plan should almost be like an evolving document. So you should regularly evolve it, because what you're doing now is most likely in a startup environment going to be different to what you're doing in 1 to 2 years' time. You might think that in 1 to 2 years you'll be selling. In 1 to 2 years, you most likely will be in quite a similar situation where you're still building your product. And then, therefore, a good practice is to update your business plan regularly. It will help prepare you for your next round of funding as well, so that when you do sort of finish your milestone and you're ready to start funding, if you regularly update your business plan, you can go straight out and visit the investors, rather than try and collecting all those little insights that you've received over the past few years, and then putting back and losing a month of time trying to put back your business plan. An obvious thing. So yeah, the business plan can be quite an extensive document showing the merits of the investor finance in your business. So it should be presented as an opportunity. And the most important thing is to just write in simple and clear English. I know a lot of you might come from a product background, but you've got to remember the investors aren't they're not scientists themselves. They might have been scientists, but now they're looking at your business with the ideas of making a financial return. So they really want to understand it. They often say as well, investors have quite a low attention span. So make it easy for them to read, enjoyable to read, and don't use too much technical jargon. You need to focus it on the investor perspective. I mean, you don't need to give all the information about the startup. Often startups make this mistake of offloading everything that they've got onto the investor, and this will maybe confuse them, or it won't actually add clarity to what you're doing. You just need to provide them with the right information. Too much information gets the right information lost. So focus on the most significant and important points about your company. Then you want to throughout the document, or throughout your pitch, you want to tell a clear story. Keep it focused about why what's the problem, why the proposal, why the proposed solution is innovative and impactful, how the investors' money will act as sort of fuel for the company, and how it represents an important stage in a very long-term plan of the company. How this investment is part of this long-term story. They want to see that you've got a good vision. Then think of the investor perspective. Yeah, as I said, the investor doesn't want to know just how cool or how technically amazing your product is. They want to really know what's in it for them. Investors are in it to make money. That's the basic fact. That's the principal reason why they're looking at it. Also, this is a personal recommendation. You might think it's time consuming, but invest in data, images, and good design. So good design So data, okay, of course, brings credibility if you can add data into your business plan. While images and good design make it an appealing document. I mean, imagine, as we said earlier, I think the average VC might see 200 of these a year. Now, if they open the document and it's a PDF, and it consists of 40 pages of Times New Roman, font 10, with very few images, just block text, block text, block text, block text. I mean, think about when you open a doc like that. It puts you off. It puts you to sleep. It puts you off. It doesn't bring good feeling to the document. And that even though it may not be related to the actual end result of the project or the business plan, that gut feeling that they have when they open the document will last. I mean, they always say first impressions are made within the first few seconds. So it's worth making your document appealing, adding nice images to the document as well, so they have a good feel of the products. And visuals work very well at displaying information and require less effort from the investor, so they will actually appreciate, considering they're normally very busy. They will appreciate the fact that you make it an easy job for them to understand your business plan. So the importance of assumptions. So your business plan will be full of assumptions. You know, who's my customer? Who's my market? How much I will send my product for? And often, because the business is not yet proven, you're not selling it on the market. You don't have anyone buying it. Or, these assumptions will be unproven. So an investor will most certainly ask, what are your assumptions, and how did you come to your assumptions? And so when you're building your business plan, you must be able to ideally justify how you've come to your assumptions. If you don't address your assumptions, the investors will focus on will just be looking at the weaknesses of the business, and will be questioning you a lot about these assumptions. Instead of having a business conversation about, okay, this is good, I like that. Have you considered this? Have you considered that? I'm very interested in making a deal with you. They'll be just really closed in on these assumptions and how you've built this plan. So there's a number of there's three types of assumptions you can have in your business plan. So primary assumptions are from personal experience. These are fantastic. You could be like, well, I've spoken to 10 customers, and 5 of them said they suffer from that problem, and they'd be willing to offer willing to purchase a solution that I have. Or you could say, I know that within my town there are X many people who suffer from this problem. So those are from personal experience. Secondary assumptions are reference. So you've read a market report or a journal, or you've found someone else has done some data collection for you, and you're referencing their document. These are obviously not as strong as primary assumptions, because those are from personal experience, but these are also strong as well. They just might not be quite as relevant for your focused market segment. Then tertiary assumptions are where you just guess. You say, I think it will cost this much. I think the buyer will pay for it at that price. You can include these, but just make sure you tell the investor these are tertiary assumptions, and you still need to qualify them. One thing for sure is don't be lazy about your assumptions. Try and quantify them. They might be a very difficult part of actually building up your business plan, but it's worth investing your time in here, because a business plan without sort of evidential claims to it and strong assumptions can sound very dodgy to an investor. So to get assumptions, you can speak to customers, other stakeholders, competitors, other investors. You can speak to value chain partners, so suppliers or distributors. One part of your innovation cycle that might provide a lot of assumptions for you will be those customer discovery activities. So when you meet your customers and ask them questions, expect that there'll be a fantastic opportunity. Don't lose out on them for building your assumptions. So the structure of a business plan, I'm going to just focus on 4 core areas of a business plan. Of course, you can look online and find template business plans and areas of a business plan, but there kind of are 5 main areas of a business plan that you will address. And I've actually presented them in an order that I believe works best. I believe it logically flows. And in fact, if you read a lot of literature as well on presenting business plans and on data on actually the success of businesses, this is a very successful model for presenting it. So start with your problem, the problem you're addressing. Although you might be obsessed with your product and you've got that temptation to start by saying how cool your product is, start with the problem. It sets context to the solution that you'll be presenting, and a clear description of the problem eventually orientates the investor to the solution. It almost makes it kind of logical in a way, and the product needs context. So the best thing is to go macro to micro. So start maybe with the context. So I've got a picture here. Cities are very polluted. Pollution, of course, has many detrimental effects to the human body, but also to the environment. So set a tone today. But then you want to focus in on the specific customer pains that you're addressing. For example, I'm going to be using the example of an air purifier. And you might be like, well, air purifiers use a lot of energy. Many people don't want them because they add heavily to their energy bills, or they're ugly, say. They're unpractical solutions. You require a lot of them. So you want to then, after setting the context, focusing on exactly what is the customer pain, the specific customer pain that you're addressing. Important as well would be to quantify the problem as well. So to add data and add credibility to the problem, and this will help when you describe your solution, because you'll be able to show why you're better than everyone else. So if we're talking about how much an air purifier consumes, give data, actual hard data about how much it consumes and how much more it might add onto a household's electricity bill. Give urgency to the problem as well if you really want to engage the investor interest as well. They want to feel that their money as well will get good use and will be adopted quickly if there is that urgency there. And then, if possible, if maybe, for example, you're not exactly solving a problem, but you're offering a new, say, service, for example, say Netflix or Spotify, they weren't exactly, solving world problems, but they're very cool tools that we now have, and we're now very reliant on. And there you could, talk about trends. You could say that people are now using a lot of cloud services. They're expecting things to be on cloud services. That's why instead of carrying your music in your phone, your music is now available in the cloud. So talk about the potential trends that will bring about an opportunity. Then following the problem, of course, you want to straight away address your solution. As we said, if you well describe your problem, it will logically flow that there's a solution, and the investor will be almost have brought himself to the solution as well. So describe the solution as a clear response to the problems you presented. Focus on what it does and what it is, what's unique about it. Is there something new you've created? Is it better or significantly different to alternatives or to competing products? Importantly, when you present your solution, this is not an academic paper, so present the features, but present the features as a way of receiving an eventual benefit. So really actually focus more on the benefits of the solution as well. Statement technology or something that uses this formula or this new proprietary blah blah blah. Okay, mention that because it's good, especially if you've got a patent or it's proprietary technology. But focus on really what is it going to offer the end user of it, because that will describe that someone's going to buy it. Say that this can cleans air without using electricity, for example. It will say XXX of the electricity bills. It has a lifespan of blah blah blah. It doesn't require change in filters XXX. Yeah, focus on really what the customer benefits of the solution are, and if possible, quantify. No, not if possible, do quantify the value proposition. So these should be aligned with what the user priorities are, what the users gain from it. Examples here might be percentage gains in quality, in accuracy, in time, in cost, and then finally as well, you also want to possess what the value the investor will get out of the solution as well. So that would necessarily be the same as the customer value proposition. They will be saying that be able to show that ideally there's a good opportunity out of it from them, instead of just the direct benefits of it. And that would be very much related to actually what we go on in the next section. They want to know that really there's a market out there for this, and people are going to buy it because then they're going to be able to get their return on the investment. So once you've done problem solution, you then go to market. So here you want to show that there is a market and there are customers for a solution. And it's important here to focus on a market. So for example, the Earth profile, of course, we could say there are 2 billion, 3 billion houses in the world that could be could buy this, but that's not very realistic. When you're presenting your business, you want to show that you've got focus and you know who your initial customer and end user is. And what you really want to do is you want to show that you know the market better than anyone else. And this counts also when you're describing the problem. You want to show that you know the market very well, and you also know your customer very, very, very well. And to help do this, there's a couple of techniques. You could do profiling and user personas. So exactly describing who your customer is. There's an activity where you could do a day in the life of the customer to help really build the picture of who your customer is. But you want to make a very specific geographic region, so people who kind of live close to you as well, but also a particular niche segment before. So this is a famous way to present it as well, as you've got your total addressable market. So that's everyone you could sell to, the served addressable market, everyone who you're able to actually sell to through your distribution channels. And then the share of market, or you sometimes call it the target market, is really who you want to target at the very beginning. So I can't really stress how important it is actually to have a very focused market. It seems very uncredible, and everyone knows that you will never be able to sell to everyone. So don't straight away present those big numbers. They say maybe actually even like 20 million to 100 to 200 million is a more realistic target market to go for at the very beginning. And then if you do have any early adopters, or what they call lighthouse customers, name them. Say that you've already got people interested in your product, especially if they are quite considerable or quite well-known names. And then, as we said before, remember, investors will generally invest in growing markets. And you want to give a realistic and growing conditions of your market, and make sure that it is a growing market if you're going to be approaching investors. And then the next part of the business plan, that kind of logically, like the problem and solution, they kind of logically fit together. You've got your problem, it leads to your solution. You've got your market, and then it leads to your business model, which exactly answers the question, how you're going to capture the market and how you make your money. So yeah, the things you generally address here is your go-to-market strategy. So how you are going to get, how you're going to keep, and how you're going to grow your customers. So how you're going to find your customers and how you're going to sell it to them. And then how it's very interesting to investors as well, is how you're going to keep those customers, because often it is your customer base that becomes your main source of revenue, the ones that you've actually got. So they want to see that you've got customer retention in there, and then how you're going to eventually grow your customers as well. Well, in the last one, we did speak really about focusing at that first market that you're going to target. That could, for example, for the air purification, I didn't give an example. For example, you could be based in Italy. You know that the price point of air conditioning is more than just a consumable. It's kind of like a luxury device, and you might know that maybe a certain societal group are much more conscious of. So, for example, environmentalist people are more conscious about the environment they live in, and the device is more effective in apartments. So yeah, what you'd be like is, okay, we're in Italy, we're going to first target Italy, so we are going to target say sort of middle upper class Italians who are environmentally focused and live in apartments. So then you'd be able to sort of define exactly how many, you might be able to have a good assumption of how many there are in that market, and then to have an idea of your total addressable market, you'll then put a number to how much they currently spend on these sort of solutions or alternatives. But then when you present your business plan, apart from targeting your first market, they will then want to see as well how you're going to eventually grow your market as well, and how you're going to scale up as well. Yeah, this should also show timelines as well. Investors will be very interested about when you're going to start selling to customers, and when you're going to move on to your next markets as well. As we said, they want to see their investment as part of a long-term plan. It's only through a long-term high growth plan that they will be able to see that, as we said yesterday, it's only, say, 10% of companies they invest in that make them all the money, and you have to convince them that you are going to be that one. It's going to become a high growth company, and it's then going to, one day they're going to be able to sell their stake for a big amount. Then you want to explain to them exactly how you're going to capture the market, how you're going to make money. So what is the business model? These might be, for example, upfront payments. You might be a subscription if you're IT. There's a lot of products are now so SaaS, so software as a service, so subscription based, use based, licensing, say consumables if you're hardware. There's the famous razor blade model. People buy the razor and then they buy the blades on top of it. That is where the money is made. You might be upselling, advertising, helping companies make savings and sharing in the savings, or operations and maintenance. So you provide something first, and then each year there's an annual maintenance fee on top of it. There's a lot of business models out there, and you should test which is the right business model for your customer. But they want to know how you'll make your money, and they will then probably ask you that question. Well, how do you know they'll pay for this? How do you know this business model will work with your customer? And that's, during your customer discovery activities, you should sort of be able to justify this. So then it includes costs, pricing, and sales. These of course will be assumptions at the beginning, but in your discovery activities, you'll be able to say that we validated that price by speaking to your suppliers or any sort of a company that you're reliant on, or including in your budget as well. When you're defining how to build your products, you might have a good idea of your costing as well. Over time, you should really look for your costs to lower, both for acquiring customers and for delivering your product, to increase your profitability. And then they'll want your sales figures as well. Then finally as well, they will, at this point, they'll expect to see your milestones as well, your milestone driven plan. So what you're going to achieve over the next sort of 18 to 24 months. Clearly the exact milestones, maybe a bit about the tasks that you're going to do to achieve them, and exactly how much you're going to need to achieve those milestones. Don't forget as well to also, if you have achieved milestones in the past, show those milestones that you've achieved in the past and how much was spent. It will give good idea of traction of your company, and maybe give them an idea that you're more likely to make it than the other company that they're probably most looking at. It's hard to give sort of milestones beyond sort of that 18 to 24 months, because as we know, a startup changes a lot in 18 months, and probably even in 12 months your next milestone might actually change. Then finally, in the last part of the document, you will want to show your team. So you want to show your knowledge, your skills, and your vision, and the strength of the team in actually carrying out the business plan and achieving success. As we said, if you manage to convince them in those first 4 slides, if you're in a high growth market, you have a proven product, some customers, then as we said, it might come down to really them investing in the team. And as we saw, the angel investors, they look heavily at the team that they're investing in. So you need to really convince them that you have the right team that's able to carry out on the build, on the business plan. So you need to show the ability of the founder, who's in the team, the ability of each one of them, their experience, and how their experience relates onto their role within the project. Also, if they have really good industry experience in particular, show that. Do they know the industry really, really well? Have they come from it from a long time? Show also the passion and the commitment of the members of staff within the team. If they're putting personal money into the company, you should for sure show this. as well. Also, you're at a startup stage. You won't have a perfect, complete team. It probably won't look like the team that you'll have in 5 years' time that will be commercializing the product and on the market. And you'll have weaknesses in the team. So be humble as well. Don't say that you have a superstar team, because of course there will be superstars, but you will for sure have some weaknesses in the team, especially if you're maybe a university spin-out. You might have for sure some competencies missing within the commercial or management side of the team. So actually, if you're aware of that, show that you're aware of it, those weaknesses in the team, and show how you actually intend to address weaknesses within the team. Show your vision as well. So where do you see, or where do you want to see the company going? And as I said again, show your passion and commitment for the team as well. So thank you very much for listening. It's a shame I wasn't, we weren't able to do it live this year, but I enjoyed being able to do that, and I've enjoyed being able to give this. I thought what I'd finish off with is a number of further reading. They're not so much about on entrepreneurship, but they're more books that will help you consider things that you might not consider when looking for financing, or most importantly, building up your financial plan. I mean, you could read more about entrepreneurial finance, but the best thing actually is to just now look at all the sources of finance that there are out there, what sort of conditions they give, and think about where you're positioned, who's offering financing in your region as well, in your area. Look at the grants and things like that. There's no point learning completely on a theoretical base about entrepreneurial finance. More look at now who is available. But these books in here will help you more in building up your business, your financial plan, and considering some certain activities that you might not have considered, or going into that depth that you might not have thought of going into, because as I said, the business plan needs to be very focused, and if you want to make it convincing, it needs to go into depth, and it needs to be very evidential and very, very convincing. So this further one is very famous. You might have heard of it. This is called Generation. So this one is very useful if you want to start building up your understanding your value proposition, and understanding a suitable business model for your company, how to generate revenues. It's more of a sort of a brainstorming approach to entrepreneurship. Disciplined entrepreneurship, on the other end of the spectrum, is more of a sort of a strategic and planned approach to building your company. But I recommend it highly. It goes into very good detail of exactly how to build up the main elements of the business plan. I mean, how I've presented the business plan there, they're like the main sections: problem, solution, market, business, and team. But there are many little smaller areas of the business plan that you should include, and this presents a lot of good tools in preparing your business plan. 0 to 1 is more of musings on entrepreneurship, but it's very good to think about some considerations for your team, and some considerations for financing as well, and how you want to sort of potentially position yourself as well. This book, The Startup Pitch, is excellent for building your pitch deck, but also excellent for thinking of ways to best present your business plan as well. In fact, the problem solution market business approach has been built up by Chris Lipp on a huge amount of research in studying famous pitches. And in fact, in that book, there's also links to example pitches, links of absolutely terrible pitches where the person's
completely gone in with the wrong approach, but also, really successful pitches of some famous companies. And then this book, High Growth Handbook, is a very good read on it. Although it is for a later stage of a company, when you're already creating lots of revenues, and when you're already on the market, and when you're looking actually now just really accelerating at a pace, like the pace of the Facebook and of Dropbox and companies like this, or Stripe, that really started picking up 100, 200 employees, 300 employees every year. But it starts makes especially if you're in a market like enterprise software or AI, where you might really be at a high growth potential in the future. It helps you start thinking ahead, because if you have a good, really good product in a high growth market, you might come to that point, and this will start helping you think and strategize ahead of the future problems that might come. It also talks a lot about the importance of your board, and the fact and approaching venture capitalists and also later stage investors. Then last but not least, this book's brilliant, HiPEAC Guide to Better Business Writing. It doesn't sound the most interesting book on the list, but actually it's like me who writes business plans every day. It was a fantastic turnaround in how to just avoid writing these very long, clunky sentences that, when I was writing them, I was like, okay, yeah, I need to add in this feature, I need to add this into the sentence to make it sound as cool as possible. But it focused on simplicity, and one of the best tips that I actually said in the book was, when you are writing your business plan or your technology, or even just an email, pretend you're writing to your mother, because your mother might not know your business or your technology so well, so you're going to write it simply and clearly. But at the same point, it's your mother. You're never going to completely disrespect her or think she's completely uneducated. So you'll also write to her in a very respectful way. So it helps you communicate better. Another tip as well, it says never do a sentence above 20 words long. And now when I'm writing business plans, I'm constantly making sure I'm under that target. So yeah, I just wanted to share those interesting books. And that's all. So once again, thank you very much for attending, and I hope you've enjoyed the course. So I'll just we've got another question. Actually, what are your tips on market validation? How should we contact potential customers, mostly large corporations, and how can we get the information that we need? Okay, so yeah, it looks like you need to sort of do a feasibility study and start validating on the market. Okay, yeah, this is always very difficult to approach big companies. They're notoriously difficult to get into. But I mean, what I first look at as well is really look for if there's any smaller companies that maybe are doing very similar to the large companies. You say mostly large corporations, but maybe look if there are some small niche companies on the market that are doing or offering a similar sort of project, or maybe they're in the supply chain as well, or maybe even speak to sort of a competitor of yours as well, might be able to provide the information you need. Otherwise, potentially target try and get into some accelerators or incubators that are maybe even run by the corporations, or look to approach them that way. The famous words said by Steve Blank from a big Silicon Valley investor. he says get out of the building. So you really just need to start picking up the phone or getting out there and networking, and eventually you might find a person who works there who might be able to add an entry in there. You may be able to find a similar company to yours, or another company in the supply chain. But I understand your pain, because there can be a big barrier between you and getting into a large corporation. And how does financing for universities spin up differs from ordinary startup? It depends on the composition of the spin-offs. Most spin-offs eventually take the form of a startup. So actually, the fundraising route is often the same. Of course, if you're completely tied in with the university, there might be some restrictions. So, for example, the fund I was talking about, the EIC Accelerator, you wouldn't be able to apply for sort of commercial funds, and VCs might not invest if you're 100% owned by, say, the university. It really depends on the cap table of the company. If you're only owned by 5% or 10%, the university owns you, you're then still a privately limited company with autonomous control. So the funding route will be exactly the same, and the milestones will be the same as well. But it also depends on how early you are in your research. So a spin-off or a startup might have been started because the technology was already found. So you're then looking to commercialize the technology. So your roadmap might focus on optimizations or customer-focused optimizations. While if you're still in a university stage, you could still be at the point where you're still doing your fundamental research. So your milestone, roadmap will look very different, and it'll probably be a bit more difficult to tell as well when you will reach your goal. But if you've spun out because your technology has been created and you're now looking for that, you've now identified your market opportunity. If you haven't yet identified your opportunity, you still have work to do. But if you've at least identified your market opportunity, then I think your roadmap will look very similar to a startup. As I said, I work with a lot of startups, and a number of them are spin-offs from universities, so they're still owned by, a minority stake is owned by the universities, and they're following the same path, the same roadmap, and the same funding path of a startup. Okay, it says hello.
Hi, can you hear me?
Yes.
Okay, perfect. So I decided to ask my question by voice because I thought it might take a lot of time to write. My name is Arya. I'm from TU Darmstadt, and I have this question about my last question in Q&A. So as you know, spin-offs usually work on research ideas, and usually try to take those ideas to the market requires a lot of additional research beyond the research that we did in the university. And for that reason, to be more specific, what I'm working on right now is quite a high-tech thing, and it's at the moment I'm a single person, and I would like to know how I can extend this idea and take it further. For example, how I can do additional research when I'm done with my PhD.
So So have you actually incorporated a company, say, that's taken the intellectual property that you've developed, or who owns the intellectual property?
Can you repeat? I didn't catch your question.
Sorry, who owns the intellectual property now?
Well, that's also my question. I still don't know if I can take the property or the research institute take the property.
I mean, did the research institute fund the development?
Yes. Yeah.
Yeah, but I think then normally they will want to at least own the intellectual property, because you've got to think as well, the research institute, that's how they make money. In the long term, they make a lot of money that comes back into universities or research institutes is from licensing of technology. So they've helped fund your research, and you're getting results from your research. So if you file a patent, obviously they're funded it. They want to keep that research within them. You'll probably be able to exploit that technology on a commercial application, because the university doesn't have too much interest in actually creating their own companies. That's not, their business model. But they will then license that technology to you on an exclusive license. They won't license it to anyone else. It'll be like as a patent lasts 20 years, it'll be like a 20-year license. And they might they might not make you pay for the license, but there'll be royalties attached to it, and they will probably want to own a percentage of a company that if you start, they might want to own a percentage of that company as well. So then they'll get dividend payments, or if you sell your company, they'll make the money as well. So I mean, if you're looking to do that, there normally is in the research institute, or if in your university, there's a technology transfer department. So you'll usually want to speak to them. But it depends if your technology is also ready to be put into that position. For example, if you've got further research to do, then you should look at research funding, because no venture capitalist or no angel investor or also the commercial grants I presented, they're not going to fund trial and error activities. So if you've still got a significant amount of, say, trial and error work to do, it's worth again looking at research and innovation grants potentially, or looking for further funding within your university environment. Does that sort of answer it?
Yes, thanks for the answer. I think so that
I'm not sure you're yet a spin-off. I'm not sure you're yet considered really a spin-off.
No, it's just a research prototype, I guess. It's
You'll be a spin-off when you create that company that has the out of the university. Yeah. Sorry, continue.
But one more question. So let's assume that I come to an agreement with the research institute, and I can try to establish the spin-off, but I still would have a research prototype and not a minimum viable product that I can present to potential investors. So what would be the best option in terms of financing and getting money for hiring new developers to come up with the minimum viable product that I can offer to the market? What's your idea on this?
Well, I mean, when you say it's a research prototype, do you still then need to do lots of trial and error work? The question is, are you able to exactly define how much you will need to get a minimal viable product, or is there still a lot of is there still a lot of technical risks that could mean that you're not able to develop a minimal viable product?
Well, from because we had this competitor in the past, and I think that there's not much risk involved because they did it. So I think it's possible to do the same, at least with some additional improvements and also innovations. But generally, it's possible because we had some other people did it in the past. Yeah. It's not a very new thing, but the way that we try to implement it might contain some innovations and new improvements.
Yeah, I mean, I'm going to say answer instead of very frank. It sometimes also depends on how you present it. Don't use the word research prototype if you're reaching an investor. Just call it a prototype of your technology. They will fund activities to develop a minimum viable product. Minimum viable product is good enough to put on the market. So, what you'd have to say is that you've developed a prototype and you need to do optimization work or development work. And, as long as you can say, you know exactly what you need to do and how much you need, there will always be that, margin for error, or you might have to go back and say, well, we didn't quite reach that milestone, but we got this data. I think you could be at a point where you could start looking to get funding, especially, for example, if you are looking to get intellectual property as well surrounding it. It depends. I mean, when you start approaching investors or start trying to get funding, you sort of also need to switch mentality as well. That you kind of need to present it more. Avoid I'd say the word research prototype if you're approaching investors.
Okay, got it.
Start looking more market focused.
Yeah, I appreciate it. Thank you.
Right. Okay. I think that's all questions. So yeah, once again, I hope you'll enjoy that and benefit from that. And here's my email address, my name as well, if you want to search on LinkedIn. But I'd be open as well to ask any other questions that you might have about entrepreneurial finance. So thank you very much, and I hope you enjoy the rest of the seminars.